Are you worried about Joe Biden's proposed increase on the capital gains tax rate? Well, if you are, you're not alone, but there's something far worse coming. I'm going to tell you what that is in today's episode and how to prepare yourself, so go nowhere. I'm Ron DeLegge with ETF Guide TV. A warm welcome to all. If you're here for the first time, hit that subscribe button. That way you'll never miss any of our episodes like this one, along with our other fine programming like ETF Battles. We've got exclusive interviews and many, many other insights. So I want to begin our conversation by giving you some context. And it's important for you to understand that we're going to connect this to Biden's proposed capital gains tax increases. It's basically the realization that correct investment outcomes do not happen by accident. They happen because of correct investment positioning combined with correct tax positioning. And it's not one or the other, but both. Both if you want to have a correct investment outcome. And those of you wondering, well, Ron, what's your definition of a correct investment outcome? Well, it's the outcome that generates the highest absolute profits to you, the investor. And that's what we're going to talk about in today's conversation. We're going to focus on how to prevent yourself from becoming victimized by higher taxes. So let's get right into it. President Joe Biden's American Family Plan, all over the news. Plan includes a large increase in the top federal tax rate on long-term capital gains and qualified dividends from 23.8% today all the way to 39.6% for higher earners. Now, when including the net investment income tax, the top federal rate on capital gains would be 43.4%. Now, rates would be even higher in many U.S. states due to state and local capital gains taxes. We're going to take a look at that in a minute just to give you some context. But no matter how much money you make, there's only three places that you can keep all that money. You can keep it in your taxable bucket, you can keep it in your tax-deferred bucket, or you can keep it in your tax-free bucket. And it's within this context that I want to help you all understand this proposal by President Joe Biden. And you'll notice here that his focus is on the investments held in the taxable bucket, because that's the only place where taxable capital gains can happen. So here's an unappetizing visual of what folks in the top 37% federal tax bracket can expect to pay on long-term capital gains under Biden's proposal. It's an average 48% across the board. And if you're a resident in some of those high taxing states like New York, New Jersey, and California, well, you're looking at a combined long-term capital gains rate well over 50%. I mean, it's just humongous. So for example, let's say you sold a $10 million investment with a built-in $8 million gain. You're looking at over half of that $8 million gain going to pay capital gains tax. It's just gigundous, which is going to leave you in this example with around $6 million in change. Not very good. Now, we know that increases in capital gains tax rate is not going to increase the amount of money that the government actually collects from taxes. And here's the proof. Biden's capital gains tax rate is projected to reduce long-term GDP and long-term tax revenue. That's according to projections by the Tax Foundation. So never mind what the government programs are going to pay for. It's not going to tackle the much bigger and more costly existing government programs like Medicare and Social Security, which are sinking this nation into financial oblivion. Now, this chart illustrates that point. The bigger problem, and this is the one that should worry everybody, is the combination of rising national debt, runaway spending. It's on the path to bankrupt this country. That's where we're heading. Now, you'll notice in this chart, we're already well over 100% of debt to GDP. We've regressed to the high debt years of the 1940s. So history, once again, is repeating itself. Except this time, the rate of government spending is going to exceed every single historical record. We're going into no man's land, folks. Now, what does this mean for you and me? Well, higher taxes for everyone, not just for the rich. There's simply not enough rich people in this country to pay for the colossal government spending. Now, any increase in capital gains tax rate on the rich is not going to move the needle. And this is a very important point. Rich people are very good at hiding their money. And besides that, most of them never sell their assets for a capital gain. They just simply borrow against those assets to avoid paying the tax on them. So the only way the government can continue to finance itself is by broadening the tax base. And that means that higher taxes are coming for everyone. And guess who's going to get hit the hardest? It's really the middle class. It's the middle class that's in the firing line and is most acutely threatened because they are the larger number compared to the rich. So guess who else thinks that U.S. income tax rates are going to skyrocket for everyone? Well, it's not just me. It's really, you could call this person, David M. Walker, the smartest guy in the room. He's a former comptroller of the U.S. government. He's written multiple books on this subject. He's got a new book out. You should check it out on Amazon.com. And he knows the numbers better than anyone, anywhere. And the quote that you're seeing here is what he told me back in January when I interviewed him on this same channel. By the way, the link to that interview, if you missed it, is posted below in the description section. So there's roughly $35 trillion held in tax-deferred retirement accounts, like 401k plans, 403bs, you got traditional IRAs in there. And the coming tax hikes to U.S. income tax rates is going to absolutely destroy all of these accounts. It's going to be far more destructive than what Biden's capital gains tax proposal is going to do. Because remember, that proposal that he's got on capital gains is exclusively centered and targeting the rich. But this one that I'm talking about is going to hit all Americans in all income brackets. With 401k plans, traditional IRA, you can throw in 403b, 457 plan, any kind of tax-deferred asset is in the firing line. So that's not just the rich people. And because the money coming out of these plans is taxed at a person's current income tax rate in the year the money was distributed, it's going to mean a lot of trouble when tax rates skyrocket. And with higher tax rates ahead, well, that means people are going to be spending more on taxes, and they'll be spending less money to fund their retirement lifestyle. And this is going to create a lot of problems for people that don't plan and prepare. Now, I do not agree with the populist narrative that you're going to be in a lower tax bracket during retirement. I know many of you have been indoctrinated with that belief. Well, I'm here to tell you that that belief was true of previous generations. It will not be true and is not of our generation this point going forward. Now, let's take a look at an example. I see this all the time. A lot of mistakes in investment portfolios that I analyze and grade at portfolioreportcard.com. And this is a common mistake that I see. People may have wonderful investment positioning, but it's often undermined by poor tax asset positioning. And remember, I said at the outset, if you want to have a correct investment outcome, you got to have both. You can't just have wonderful investment positioning while ignoring tax or asset positioning. So in this example, we got a married couple who's amassed a $1 million IRA or a $1 million 401k, or it could be another type of investment account held in their tax-deferred bucket. Now, as you learned earlier, this bucket, along with the taxable bucket, is the most threatened by rising U.S. tax rates. Now, all the money that you withdraw from your IRA or 401k plan is also taxed at your ordinary income tax rate. And so when tax rates double, and I believe they will very soon, it will be a double increase for all income earners, not just the rich, like Biden's current tax proposal targets. Do you know what that means in terms of what kind of chaos that's going to cause in this country? So if tax rates double, that means you took a 50% pay cut because taxes are now consuming a disproportionately large portion of your income. And that's why it's so important to limit, and I know this sounds a little bit odd to some of you that I'm saying this, but hear me out. It's so crucial to limit the amount of money that you keep inside your tax-deferred bucket with the purpose of neutralizing the insidious impact of skyrocketing tax rates. And so you want to limit that amount, and of course you want to systematically place the rest in your tax-free bucket. We'll get to that in a second. Now, getting back to our married couple, in this example, at age 72, when required minimum distributions kick in on those tax-deferred retirement plans, and that $1 million account begins to actually trigger RMDs, that's going to be $36,000 of income in the first year. So if you're married, keep in mind that 2021 standard deduction is $24,800. Now, if you're single, it's $12,400, a lot lower if you're single. So you can already do the math on this. If you've got a $1 million IRA and that RMD in year one is $36,000 and you're married, you're already $11,200 above that standard deduction. So strategically speaking, you want to keep that RMD from that $1 million IRA at or below your standard deduction. Because if you do that, then guess what? That RMD is essentially a 100% tax-free distribution. Does that make sense? See what I'm telling you here? I'm saving you money from taxes. This is a very simple way to do it. Now, of course, proper planning also ensures that none of your Social Security income ever gets taxed. And to make that happen, you have to make sure that your RMDs, along with half of your Social Security and all your other income sources, are at or below the IRS provisional income thresholds. And with this example, our couple, their RMDs are so large that it pushes them way above the IRS provisional income limits, thereby triggering another tax on their Social Security income. And that's exactly what we never want to have. We don't want to have taxes on Social Security income. And, let me go back real quick before we continue. So when we double U.S. income tax rates, because that's where this country's heading, and you have a $1 million IRA or 401k plan, you're really setting yourself up for disaster, because the tyranny of taxes pose a very acute threat. And then, of course, you have the threat of a market crash and the spend down from all of that comes from the higher U.S. income tax rates plus taxes on Social Security income. I mean, it's all a toxic combination that most people aren't even aware of, let alone ready for. So consider yourself blessed that you're learning about this, learning about the problem, so that you can avoid the disaster. Let's take a look at some historical context. How high will U.S. income tax rates be in the future? That's a question you're probably wondering. We're all wondering that. Well, let's give you some context. The highest 37% federal tax bracket in the U.S. today, that is the third lowest in the past 89 years. Now, the question for the audience is this: is 37% high or is it low? I'll give you a minute to answer. Now, compared to history, it's low. In the 1940s, the highest tax bracket was 94%. So 37 is lower than 94 by a lot. The bigger problem that we need to think about is, where's that 37% bracket today headed into the future? And what about all the other brackets underneath it? Will it be higher or will it be lower in the future? Now, if you think it's going to be higher, I agree with you. A double on today's 37% top tax bracket brings you to 74%. And those of you saying, well, that could never happen, Ron, that's just crazy. We could never go from 37 to 74. Well, that's pretty close. When you look at history, 74, that's pretty close to what the top tax bracket was in the 1970s. So remember, what do they say about history? That's right, it repeats itself. So many of you watching this are now realizing the problem of having too much money stored in the wrong places, right? Poor tax positioning. Maybe you've got wonderful investment positioning, but you got poor tax positioning. And again, the winning formula is to have both. Correct investment positioning along with correct tax positioning. You can't have one or the other. You need both. Let's talk about solutions. Using the previous example of that $1 million IRA, how do you reposition that money so as to permanently eliminate the damage of skyrocketing tax rates? Well, the answer is to shift money starting this year out of your taxable bucket, out of your tax deferred accounts, and you shift that into your tax-free accounts, like your Roth IRA, Roth 401k, and also there's something called a LERP, which we're not going to discuss today, but that's another strategy. Now, you have to do this strategically, especially if you've got a large sum that you've been accumulating over decades. You cannot shift $1 million from your tax deferred account. You can't just shift it into your tax-free account in 1 year because it's going to cost a lot to do that, right? You have to do it in a systematic way. I usually recommend a 5 to 7 year period. Sometimes it might be a little bit longer, depending on the amount of taxes that it creates. But you want to do it fast enough before income tax rates go up forever. But you also want to do it slow enough so that you're paying the taxes on the shift without changing your current lifestyle. Again, what does that shift consist of? It can consist of contributions in terms of savings out of your current income. It can also include conversions, converting a traditional IRA, a portion of that to a Roth, and doing that, again, systematically. So we're going to end today's conversation with the question, are you properly positioned to beat the coming wave of higher income tax rates? What are your weaknesses? How can you improve? And what can you fix? And guess what, people? These are the things that we talk about and I look at portfolioreportcard.com. So get in touch with me if you'd like to find out. That's the only way to know where you're at right now and where you're heading. You got to get a proper diagnosis. And then, of course, I recommend a re-diagnosis to make sure that you're staying on path. And certainly I can help you with that. So coming up this week on ETF Guide TV, here's what I'm going to drop on you. I got a new ETF Battles episode coming up, Invesco versus Vanguard. This is a big one. So you're going to enjoy that. Plus, I had a friend ask me about dividend ETFs last week. And he asked me, well, Ron, what's the best dividend ETFs to invest in? So I'm going to share with you my insights on that. And also, I'm going to do a piece on the barbell portfolio, which is something that has been popularized by a fellow by the name of Nassim Taleb. We're going to take a look at that underneath the microscope. So that's what's coming up this week on ETF Guide TV. I hope you've enjoyed today's conversation. Hopefully it's been enlightening, that you see that there's far worse things ahead than the proposed capital gains tax, which is just limited to the rich. We've got higher tax rates in this country. That's where this runaway spending is heading, the out-of-control debt. And so now's the time to prepare yourself to remove yourself from the coming chaos. So that does it for today's episode. I hope you've enjoyed the program. Be sure to subscribe to ETF Guide TV. Post your comments. Let me know what you think about today's conversation. I'm Ron DeLegge. We'll see you next time. Thanks for watching.